Hi everyone, Shaun Humphries here. Welcome to this edition of the All Things Retirement Podcast. Well, if you're an incorporated business owner, you'll enjoy this particular presentation. Our guest speaker is Thomas Holmes, CPA. Thomas has had extensive experience working with incorporated business owners on various tax planning strategies. Today's topic, we're going to unpack a little bit the whole area of unlocking assets or income from your corporate structure for retirement. I'm quite surprised when I talk to business owners. They often have a lack of clarity in terms of how they integrate their registered retirement income funds, their tax-free savings accounts, and their non-registered portfolios with their corporate assets. So Thomas and I are going to talk about this topic and provide you with a little bit of clarity on how to look at this whole area of unlocking income from your corporation as you look at your retirement income planning. Hope you enjoyed this edition of the All Things Retirement Podcast. Hi everyone, Shaun Humphries here. Welcome to this edition of the All Things Retirement Podcast. In this edition of the podcast, we're going to talk about some very important tax planning matters for small business people and incorporated professionals. And joining us on the podcast today is Thomas Holmes, CPA and CA. Thomas, thanks for joining us.
Thanks for having me, Shaun.
You know, one of the areas that we get involved in with clients when it comes to retirement, and particularly for small business owners and incorporated professionals, is to try to give them some guidance on this question of, okay, Shaun, what do I take out of my corporation for retirement income? How do I merge that with my RSP accounts that'll convert to RIF accounts, my TFSAs, my non-registered portfolio? It seems like a bit of a confusing topic for many clients. And so one of the things we try to do is to kind of give them guidance on the optimized mix around the various income streams, particularly for self-employed professionals or incorporated small business people. It's a real open question, and it's something that we feel needs to be spoken about a little bit in terms of, at a high level, the kinds of things that they should be thinking about. Obviously, it's very situational specific, and they need to get specific advice for their circumstances. But when we talk about that mix between draws from the corporation and their own personal assets, what are some basic planning points around that?
That's a great question, and I think you kind of nailed it when you said it was very open-ended. When the one constant when dealing with incorporated professionals and business owners as they enter retirement, if they have a holding company that holds some of their retirement assets, the one constant is a need for a plan, and this is a plan that should be done fairly regularly with someone like yourself or with a tax professional. You have to weigh a lot of factors. When an individual retires that has a corporation, that corporation often is often their largest piece of their nest egg, and thus will form a large portion of their retirement income going forward. And so we try to map it out so that we weigh the cost of withdrawing dividends from that corporation versus the cost of keeping that corporation going long term.
Okay.
What people sometimes think is that once they retire, they have this corporation and they'll just wind it up. Mm-hmm. And they fail to realize that when you wind up that corporation, you have to pay a large dividend to liquidate it.
Exactly. Yeah.
Exactly. So like you said, we'll try and draw it down in a logical manner while weighing the other factors such as old age security clawback, mm-hmm. and the potential for them to be entering the RIF stages of their life. And so I think what we will often see is individuals with corporations will aggressively draw down their income from the corporation in their 60s, okay. And then because we know that starting in the early 70s they'll have to start drawing their RIF income down.
Okay, so they'll use that as a bit of a window of opportunity to get that money out because of the other sources of assets,
exactly.
Or income they'll get from their RIF accounts or other registered assets.
Exactly. Okay. Depending on their retirement date, there's often a short window when we can pay out some substantial dividends in order to make a big dent in that corporation prior to them getting CPP or OAS or RIFing and all the other types of retirement income that are coming due.
Okay.
A lot of individuals will also, and I don't blame them, get tired of paying compliance fees, mm-hmm. and so they'll have this inactive holding company holding investments, and they're wondering why they're paying their accountants and lawyers every year. And we'll often prepare an analysis that'll show them that the cost of keeping it going from a compliance perspective is well worth it, as it's allowing them to continue to defer income.
Exactly, and I think that forecasting is critical because then you can step back and see the real net benefit over time of the different strategies.
Absolutely.
So it's almost like an income averaging plan that you develop for your corporate clients to give them an idea of what to take when.
Absolutely. We try and I think you hit the nail on the head there. I think a lot of accountants, or a lot of people in general, will take just a random number of dividends every year because it seems reasonable. I think we realize that the important thing is to take a step back, figure out exactly what that client needs every year from an income perspective, and then model the best way to do that. And in some cases, it might be some years we might end up taking a large amount out of their corporation by way of dividends. And other years, if they've received other income from other sources, potentially sold non-registered investments or started pulling a pension income stream, we might realize that this year it doesn't make any sense to pull investments out of their corporation or pull dividends out of the corporation.
Okay, that's excellent advice, Thomas. And so I think the bottom line is every situation is very specific in terms of the expense requirements. It has to be laid out as a long-term plan. I think it's very easy for people to kind of look at the next year. How am I going to initiate the strategy? But it's very important to step back a little bit and look at the next 5-10 years and to see what makes most sense in the context of that plan. Because you're right, down the road there will be other sources of income, whether it's old age security or maybe CPP, and certainly the RIF payments that'll come out from registered assets can be a big hit to income. So
absolutely.
That's great advice. Thanks so much for joining us today.
My pleasure. Thanks, Shaun.
Well, I hope you enjoyed this edition of the All Things Retirement Podcast. I think Thomas did a great job of unpacking the whole area of unlocking income from your corporate structure when you retire. We put together a comprehensive planning process that we call Game Plan. Game Plan pulls together every aspect of your retirement game plan and income planning to develop one cohesive strategy and plan. Specifically for business owners, we have very specific modules that deal with the integration of your corporate structure with your personal financial planning. And we have experts like Thomas that develop very specific tax planning strategies to unlock your corporate capital as a way of supplementing your retirement income needs. For more information on Game Plan, don't hesitate to visit our website at www.shaunhumphries.com. We have resources on all aspects of wealth planning, and you can find specific information about Game Plan. If you have any specific questions, don't hesitate to contact us at 204-977-8022. And of course, our email information is on our website and on the show notes for this particular podcast. Wishing you all the best as you plan to grow your wealth through retirement.